I'm the CEO for the Australia-UK Chamber of Commerce. We're a members organisation and we're here to support, inform, connect people in the UK community who have interests in the Australian marketplace. We have, I guess, just some housekeeping up front to deal with, so I'll just cover that. The question I think a lot of people will ask right away is, will this session be recorded? And the answer is yes. We will host this on our webinar, on our website. And secondly, we will provide a link for you to access it as well in the next 24 hours or so. In terms of the presentation itself, it'll run for the 60 minutes. We've got around 45 minutes of content, and we want to allow about 15 to 20 minutes for the Q&A. No surprise, this has been given an extraordinary response in terms of the number of people that have registered for this. These tax expats that are going to be experiencing and are experiencing are real, and frankly, I wouldn't put in the positive bucket. And this has created enormous unrest and interest from the expat community, not just Australians, but the general wide expat community. These changes came in last year. Menzies, who are going to host us today, covered parts of this in a presentation last December 2025. And what we're going to cover today was done in a small part, but we're going to expand on it in this session today. Again, this will be recorded, a link will be sent, and also there was a lot of questions asked in advance, which was incredibly helpful. No surprise, again, they're very specific, and we won't clearly identify any individual with regard to their questions, but this presentation hopefully will cover those in a general sense. And for those where their questions aren't specifically answered, we will obviously make sure that we connect our speakers, the experts at Menzies, with you in the follow-up process, so you can round back and get an answer to your question in some shape or form. Again, I'd like to just introduce my colleagues from Menzies, and I'll let Martin Hamilton, a partner at Menzies, explain who they are and what they do. But Martin Hamilton, Helen Cuthbert and Anisha Chawla. Now, Anisha, Helen and Martin were here last time, and again, the feedback from their presentation was really positive, and no pressure, team, but we expect a fine performance again today. So I'm going to pause here. I will come back. Everyone who's joining this call is on mute and their image is also off. So we'll have a free run just running through the presentation. Then when we go to Q&A, we will work through what will be in the top of the screen. You'll see a Q&A button. Please feel free to use that Q&A button to ask questions. We'll review those during the course of the webinar itself and raise those at the end of the presentation. So that's it. We've got about 55 minutes on the clock, about 40 minutes of content, and at least 15 minutes for the Q&A. And on that note, I will hand over to Martin.
Thank you very much, Richard. Pleasure to be back again in collaboration with the Australian Chamber, doing a webinar for its members. I'm just going to do a little bit at the top here and leave the content to my colleagues. As Richard said, we have Anisha and Helen on the webinar today, both private client specialists, and Menzies as a whole are a full service offering accountants in the UK. I'm a partner here from the international team, and I head up our Australian desk. So I do a lot of work with the Chamber. You may have seen me around or seen us on other webinars, but we do help Australia businesses entering and operating in the UK market, as well as Australian individuals in the UK as well. And I think this webinar is solely focused on the individual side, as Richard said. there is some questions that have been asked in advance, and please use the Q&A option to ask questions as we go along. We'll answer as many as we can, but you will see our email addresses during the webinar, and as they're here now. And after the webinar, you'll be sent an email with the video and links and our profile. So you can reach out if you have individual questions, for which there are many that have been asked already. So we can hopefully help you if you reach out to us post the webinar. So without further ado, as we've got a lot to get through, I'm going to hand over to Helen and Anisha and let them start this webinar, and then I'll come back at the end to ask some of the questions that have been asked in advance and during the webinar, and we'll go from there. So Helen and Anisha, over to you.
Perfect, thanks Martin. So for those of you that may have attended our previous webinar, you'll recall that we looked in detail at the changes announced as part of the UK budget in October 2024, so particularly the reforms impacting the non-dom regime. So whilst those broader changes continue to be a key area of focus, today's session is really intended to take a more practical approach. So in particular, we'll focus specifically on the transitional measures that have been introduced as part of the new regime, how these provisions operate in practice, and some of the key planning points and technical considerations arising from them. A number of these transitional rules are time sensitive, and in many cases their application will heavily depend on an individual's particular facts and circumstances. Therefore, what we want to try and do today is move away from those headline announcements and instead look at how these rules are expected to apply in real life scenarios, including some of the common issues and questions we're currently seeing in practice. So before looking at the new regime in more detail, we thought it might be helpful to briefly touch on how tax residence in the UK is actually determined. So it's determined under the UK Statutory Residence Test, or the SRT. The rules operate through a series of tests. So first, there are 3 automatic overseas tests, which can confirm an individual is non-UK tax resident. Secondly, there are 3 automatic UK tests, which can automatically make somebody UK tax resident. And then if you can't conclude under those tests, there's the sufficient ties test. The sufficient ties test looks at a combination of the number of days spent in the UK and an individual's ongoing connections or ties to the UK. These ties generally can include having family in the UK, accommodation in the UK, working, spending significant amounts of time here, and the number of days spent in previous tax years. So although the rules can sound relatively straightforward at a high level, in practice they can become quite complex, particularly for those travelling between jurisdictions. Often people come to us and say, I need to spend less than 90 days to become non-tax resident. 9 times out of 10, that's just not the case, and there's more factors to consider to determine your overall UK residency position. So in light of the abolishment of the non-dom regime and the fact that UK tax exposure now rests on UK residents alone, it's really key to seek professional advice before relocating to and from the UK or prior to restructuring any assets. Some of the more common areas or issues we see that arise in practice are miscounting UK days. So there's a specific midnight rule that says that if you're present at midnight, that will count as a UK day. Misunderstanding how UK workdays are calculated and what constitutes as UK duties. So often as we have remote working, people can log on, look at emails, attend a few calls, but actually that can create a tie to the UK and be the pinpoint to make you UK tax resident. Retaining unexpected UK ties following departure. And the final one we see quite often is assuming that residence is determined solely by either your immigration status or your visa position. That has no bearing on your UK tax residence position, and we would look only at the statutory residence test. Moving on to split year treatment. So where an individual arrives or departs from the UK partway through the tax year, split year treatment may be available. So it allows the tax year to be divided into a period of UK residents and non-UK residents, and that can have a significant impact on the taxation of your UK income and your worldwide sources of income. Correct application of the split year provisions can be really valuable at managing UK tax exposure. But again, these rules are complicated, meaning that the conditions need to be reviewed carefully on a case-by-case basis. It's often the case that in the year of departure or arrival, conditions need to be met, but also in the following tax year. It's also important to note that split year is not elective, so where the conditions are met, the treatment applies automatically, and therefore it's essential to ensure that your position is reviewed correctly, but also reflected on your UK tax return correctly. So as a UK tax resident, you're subject to UK tax on your worldwide income and gains, subject to availability of foreign tax credit, unless you're a new arriver under the new FIG regime, which we'll go on to shortly. Finally, one of the major changes introduced as part of the October 2024 reforms is the introduction of the concept of long-term resident. So broadly, an individual will become long-term resident if they have been UK tax resident for 10 out of the previous 20 tax years. This now has an impact on your exposure to UK inheritance tax, but Helen will touch on that shortly. So moving on to the introduction to kind of the changes that took effect from 6th of April 2025, if we start with income and capital gains, we have the foreign income and gains regime. So under this regime, individuals moving to the UK may be eligible for relief from UK tax on most of their foreign income and gains during the first 4 years of UK tax residence. To qualify, the individual must have been non-UK tax resident for 10 out of the previous 20 tax years. It's quite a significant regime as it allows people with a limited window to reorganise or access their overseas wealth more efficiently before becoming fully subject to UK tax on a worldwide basis following the expiry of the 4-year period. Unlike the former remittance basis regime, foreign income and gains are not simply excluded from reporting. So if you do benefit from the FIG regime and make a claim, you're required to disclose all of your foreign income and gains on your UK tax return in order to claim the exemption from UK tax. So whilst generally it's viewed as less generous maybe than the historic remittance basis regime, it still remains a valuable relief for individuals looking to relocate to the UK. Moving on to the temporary repatriation facility. So that facility was introduced for individuals who previously might have claimed the remittance basis under the old non-dom rules. It's available only for a limited period, so for 3 tax years, being 25-26, 26-27, and 27-28. It lets eligible individuals designate and remit foreign income and gains that arose prior to 6th of April 2025 that would have previously been protected by the remittance basis. So instead of paying tax at the usual rate, so UK income tax or capital gains tax rates, which are significantly higher, the designated amounts will be taxed at a flat rate of 12% in 25-26 and 26-27 and 15% in 27-28. Once you've made the designation under TRF, you pay the tax on that amount through your self-assessment tax return, and no further tax will be due on that designated amount, even if the funds are remitted later. It is advisable to keep those designated funds ring-fenced so that you can keep track of how much you've designated and how much you've then later remitted to the UK. Whilst 25-26 has passed, if this is a consideration for you, there's still plenty of time to consider this, as the designation doesn't need to be made until you actually complete your 25-26 tax return, and that doesn't need to be filed until the 31st of January 2027. So in summary, the TRF can be really valuable for anyone planning to stay in the UK long term. So it's really important to plan ahead and make sure you do take full advantage of it. The reporting requirements for TRF are quite complex, and HMRC are requiring a certain level of detail around your bank accounts, so seeking guidance before you remit is absolutely key. So if you have an account which you're not sure where the funds arrive from, it's been mixed over years, it's definitely beneficial, perhaps if you need the funds in the UK, to designate under the TRF. It's only available until April 2028. and please do consider any remittance planning proactively rather than waiting until the funds are required in the UK.
Thanks, Anisha. Just a couple of points about the TRF before I move on to inheritance tax and trusts. So the TRF is really sitting there as an incentive for people to bring funds into the UK. And I think it's worth noting that when the idea first came into draft legislation, that the plan was that it would be quite a simple relief and quite a simple process. I certainly don't think that that is how Anisha and I view it, and I don't think many of our taxpayers will see it that way as we go through the next couple of years. So moving to UK inheritance tax, I know that is a relatively emotive subject when I talk to individuals who are nationals of other countries, particularly our friends in Australia and New Zealand. So UK inheritance tax is a tax on death, but it's also a tax on lifetime gifts. So if we're giving, and it's not a recipient tax, it's a donor tax. So the tax arises on the estate or on the lifetime of the person who's making a gift, either on death or in life. So what's the exposure and what's the rate? The headline rate of UK inheritance tax is 40%. So it is quite a steep charge. The impact of it and the exposure is either going to be on UK assets only or on worldwide assets. So who falls into which camp? Those individuals who are not long-term residents, so to recap, that's people who have not yet been in the UK for 10 complete tax years, will just be exposed on their UK assets only. Once they trip over that 10-year period, their exposure then grows to their worldwide assets. If there is a tax charge that happens at the same time, that is an overseas inheritance tax or an estate or gift tax on that asset at the same time, then credit is available where an asset is taxed in 2 jurisdictions. I'll go over the long-term residents and the IHT tail on the next slide in a moment. So let's move to trusts. So popular planning for our old non-DOMs, so people who'd chosen to live in the UK for a period of time, but people who intended to go back home to their original national jurisdiction. So very popular planning. And the reason for that is it provided protection, not for UK assets, but for overseas assets. And it provided that protection while those individuals were living in the UK. Unfortunately, that environment has changed significantly now. And the tax environment of what we call an excluded property trust. So I'll go through what that means in just one second. So the tax environment for an excluded property trust will now follow the long-term status of the individual who created that trust in the originally. So what's an excluded property trust? Excluded property is a complex word for assets that do not sit within the UK tax net. So offshore assets. Relevant property are assets within a trust that are subject to UK tax. So historically, that's been UK assets only for a non-dom creating a trust. Going forward, once that settler, so the person who set up the trust, has been here for 10 years or more, the trust will now become relevant property. So all the assets within that trust will become within the scope of UK inheritance tax. So lots to think about. Trusts do still have a place in UK planning, not least because they provide family wealth planning, protection on divorce, etc. But the tax status of those trusts is not as beneficial as once it was. Next slide, please, Anisha. So turning to this IHT tail, and what does it mean? It means that an individual will be just subject to UK tax, UK inheritance tax on their UK assets while they are here, and they're here for fewer than 10 years. Once they trip over that 10-year period, they will become an IHT long-term resident individual, and their exposure moves to their worldwide assets. That exposure to worldwide assets then sticks with them even after they leave the UK. And that's where we get into the tail idea. So the tail is how long the IHT status sticks with you once you've left the UK. At an absolute maximum, that is for 10 years. So if you think about it, you've got at least 10 years of residence. Let's take somebody who's been here maybe 25 years. They're subject to UK inheritance tax on their worldwide assets now, because they've been here for 25 years, which is obviously more than 10, and they will retain that status for the 10 years after they leave the UK. So definitely worth thinking about and understanding that exposure to UK inheritance tax. Right, Nisha, thank you.
So one area we thought that would be particularly useful to cover, and something that perhaps might be overlooked when individuals consider their affairs, is the concept of dual tax residence. So where an individual is considered both tax resident in the UK and, in this case, say Australia, under each country's domestic law, it's necessary to refer to the UK-Australia Double Tax Treaty to determine in which country the individual should ultimately be treated as treaty resident. So, for example, if you have an individual who becomes UK tax resident under the SRT, while also remaining Australian tax resident because they've spent 183 days there, you'll be resident in both. In these circumstances, the treaty tiebreaker provisions are applied, and these are a series of tests contained within the treaty which are intended to allocate treaty residents to one jurisdiction only, and these tests must be considered in a specific order. So the first test considers where the individual has a permanent home. That's not necessarily, it doesn't require ownership of a property, but somewhere that's available to the individual on a continuous basis for their use. In practice, most people have a permanent home in both jurisdictions, so we typically will look at the next test, which is the Centre of Vital Interests. This can be the most subjective aspect of the treaty analysis and involves addressing where the individual's personal and economic connections are the closest. So the relevant factors that might be considered are where their spouse or family are located, where the children attend school, where employment or business activities are carried on, where investments and banking relationships are maintained, social and lifestyle connections, and where the individual ultimately spends the majority of their time. If the position is unclear under the Centre of Vital Interest, which is quite uncommon, then the treaty can look at the individual's habitual abode, which is effectively where they habitually live or spend more time, and it then moves on to nationality. In very rare cases, you can seek approval from the tax authorities, and they will determine where you're treaty resident. So as a result of the changes, we do expect that dual residence becomes increasingly prevalent, and as this receives greater focus, we do expect the HMRC may start looking at treaty residence in more detail. So it's really important that you ensure that your overall position is reviewed and also documented, and it will be key in managing any potential challenges going forwards. So moving on to some case studies, the first one kind of highlights how important the timing can be under the foreign income and gains regime. So in this scenario, we have Daniel, who's been UK tax resident for 30 years. He left the UK in 2017-18 and became tax resident in Australia. He then remained tax resident in Australia since then, but he is now considering a return to the UK. He relocates to the UK in April 2026, so his first year of tax residence is 26-27. At a first glance, Daniel might assume he could benefit from the 4-year FIG regime, but actually he hasn't achieved a full 10 years of non-UK tax residence, so he wouldn't qualify for the FIG regime. If he were to delay his arrival to the UK until 28-29, he would then satisfy the requirement of having been non-UK tax resident for 10 out of the 20 previous tax years. So the key takeaway really is that advanced planning and counting your years of residence is key, because if he came back in 26-27, he wouldn't have benefited from the regime, and he would have been taxable in the UK on his worldwide income and gains. So this is something that we're seeing often in practice, where relatively minor timing differences can lead to, significant different tax outcomes. In many cases, individuals have spent, small periods in the UK or have earlier inadvertently triggered UK tax residence without fully appreciating the implications, or they haven't sought advice at the relevant time, and that can impact the availability of these reliefs. Moving on to the next one, the temporary repatriation facility. So Anna, in this case, was previously non-UK domiciled who lived in the UK for several years. She historically claimed the remittance basis. Over time, Anna accumulated mixed funds within an overseas bank account, which consisted of clean capital of £20,000, income of £50,000, and capital gains of £200,000. Historically, one of the key issues for remittance basis users was bringing offshore funds into the UK without, triggering significant UK tax charges under the mixed fund ordering rules. So as a result, many individuals retained substantial overseas balances because they were reluctant to remit. The TRF has been introduced to incentivise people to bring funds to the UK and a temporary opportunity to benefit from the reduced tax rates. So in Anna's case, if she required all of those funds in the UK, she could designate the full foreign income and capital gains through her tax return and pay the tax at 12% if she, say, did it in 25-26. She wouldn't need to designate the clean capital because that can be remitted tax-free, and clean capital is generally funds that you've accumulated before being UK tax resident, with some caveats. You can also make partial designation, so it doesn't need to be the whole account. So in this case, if she only needed a small sum of funds in the UK, she should consider designating income first, because that would carry the highest tax rate outside of TRF, so at 20%, 40% and 45%. Once she's designated, she doesn't need to bring the funds over immediately. They can be brought later, so that will provide greater flexibility for her. Helen, it's over to you.
Thanks, Anisha. So back to UK inheritance tax. So hopefully a little bit of a case study here. I've got a couple here to help you digest the main points about inheritance tax that we spoke about a moment ago. So Sanjay's lived in the UK for 6 of the last 20 years. He's therefore not yet long-term resident. He's got various assets. He's got a UK main residence. He's got a UK investment portfolio. So he's got 1.1 million of value in the UK. And he's got an Australian home worth 750 and a foreign bank account worth 10. So he's got a total estate of 1.86 million. We're going to say that Sanjay is sadly widowed and he's leaving his estate to his children. We're also going to say that his late wife has already used her allowances on her death. So her allowances are not available to carry forward to him. So his estate qualifies for 2 main allowances that we have in the UK, which are the nil rate band. So that's the amount at which the inheritance tax rate is 0, and that's 325k. And the residence nil rate band, which is 175k, and that's available where you leave your UK main residence to your next of kin, so your lineal descendants. Next slide, please, Anisha. So his estimated UK inheritance tax position. So we're just taxing the 1.1 that sits in the UK, that has a UK situs. He has total allowances of 500,000, leaving a taxable estate of 600,000 with IHT at 40%, which is 240, and that will need to be funded out of the assets that sit in that estate. So if you're not yet long-term resident in the UK, it's worth noting that you still get the UK allowances. So once you're within the UK tax net and you have some UK inheritance tax to pay, in this instance, because Sanjay has UK value, has UK cited assets, that you get those allowances, even though only your UK assets are caught to tax. Next slide, please, Anisha. So what would happen if Sanjay remained in the UK for another 4 years? This would, of course, make him long-term resident. What's going to happen is his estimated UK IHT position is now going to significantly increase. So his whole estate is now caught, and that whole estate is worth 1.86 million. If we take the allowances off again, we get down to 1.36 million. And as long as my numbers are correct, then we have an IHT bill at 40% of £544,000, which is a significant cost. So as a long-term UK resident, Sanjay's worldwide estate is subject to UK inheritance tax. And of course, those offshore assets would not be within the scope if he were not classified as long-term resident. We used to be able to protect those offshore assets by popping them into a trust. We can't do that anymore because, well, we can put them into a trust, but it's not going to provide the protection because Sanjay's long-term residence status will travel into the trust. What do people like Sanjay do? And I think it's worth commenting on this at this point while it's fresh in people's minds. Often they will think about insuring against the risk of Sanjay passing away while he is long-term resident and while that IHT tail attaches to him. Okay, next slide, please, Anisha. Often we come across individuals who have mixed status. So what we mean by that is you have one who is LTR and one who is not yet LTR. So what I want to flesh out here is what happens when assets move between individuals with differing LTR status. Think of this from the UK HMRC perspective. They want to make sure that they get their tax on those worldwide assets as far as possible. So if I have two individuals who are both non-long-term resident, then assets can move freely between those individuals where they're married. So married or civil partners, and that's because we have a spouse or civil partner exemption. And because they are both non-LTR, the HMRC cannot really grab any more tax from them other than on their UK assets. And they know that they will get the tax on those UK assets when the second spouse to die passes away. So the survivor, so we get an exemption from spouse one to spouse to the spouse, and then when that individual passes away, those assets will be charged to tax. Let's look at David. David is LTR, but Emma, his spouse, is non-LTR. David's estate is worth 5 million, and those assets are sitting there in the UK. Because David is long-term resident and Emma is not long-term resident, the spouse exemption gets restricted. So we're not going to have a complete spouse exemption like we would for me as a long-term resident passing to my long-term resident husband. That spouse exemption is going to be restricted. And the reason for that is that they are concerned that when Emma passes away, if she remains non-long-term resident, the HMRC will no longer be able to grab the tax on any non-UK assets because Emma will be outside the scope of UK tax on those assets. So the spouse exemption is restricted, but David will also get his nil rate band. So actually our exemption is 650, so 2 lots of 325. And so we have an immediate UK IHT charge of approximately 1.74 million. Slide, please, Anisha. So a little bit more now on some planning points. So what can we do? As I said earlier, previously, we've largely relied upon vehicles such as trusts. Now we're going to turn to some solutions that perhaps we kept for domestic UK clients because they're going to help our former non-dom family of people here in the UK. So what can we look at? I'm not necessarily going to go through these in order, but let's look at the things that we see the most often. Let's look at business property relief, which is the second point on that slide there. If our individual has value, but it's in a trading company, so it's in a business asset, then we have relief in the UK against UK tax, and that relief is up to 2.5 million of asset. If we have two spouses with value each, they each get 2.5 million. So we're looking at value of 5 million. So no UK inheritance tax on that value. Anything over that amount, so if it's a very successful business, anything over that amount gets taxed at 50%. So 50% of the 40%, so you get relief, and so your headline rate is 20% IHT. So that's on business property relief type assets and agricultural property relief assets, so farms, farmhouses, etc. Something we use often is a family investment company. And the reason we use this is because a company can be quite familiar to clients, perhaps more so than a trust. So what does a family investment company do? It does pretty much exactly what it says on the tin. Investments go into a company, normally cash or a loan goes into the company, and the company invests in various stocks and shares, etc. And the benefit of having your assets that are generating dividends within a corporate environment is that those assets can generally grow with a kind of gross tax-free roll-up. So dividends received from those assets sitting within the company are often received by the corporate without paying UK tax as a dividend exemption. So it's a beneficial environment, and the headline rate of corporation tax in the UK is 25%. So that can be better than holding investments individually and needing to pay income tax on those investments. And the other advantage of a family investment company is that you can get the value spread across various members of the family. So by doing that, what we tap into are some minority discounts in terms of share value. So instead of holding all the value in one person's name and all the value being in their estate, we can spread that value maybe amongst 4, 5, 6 people. We'll have different shareholders with different amounts of value, and the value of each of those constituent shareholdings is just valued on the value and just headlines on the value of their shares. So it doesn't pull in what we call related property. So it doesn't pull in them being part of a group of people that own 100% of the company. So it's using valuation to help us rather actually than tax rules. So family investment companies are a really good vehicle. What I would say is that they're there for fairly significant levels of wealth, because having a company to run brings with it cost and bureaucracy and annual returns, etc. So really, you're probably talking about sort of 2 to 5 million and above. Something I did mention earlier when we were talking about Sanjay is using insurance. So insurance can be really valuable, particularly where somebody is eventually planning to leave the UK. And I think I speak to some of the audience here in saying that. Maybe it's not the moment to leave the UK just yet, but you're worried about this inheritance tax exposure and you're worried about the tail that's going to come even after you leave the UK. Insure against the risk of sadly passing away during that time, and perhaps that insurance will come at a respectable cost. So speak to our Menzies Wealth Management individuals to talk about the cost of insurance or your own individual IFA. Finally, pensions. So unused pension pots that are sitting there at the date of death. At the moment, they are not chargeable to UK inheritance tax generally. If that unused pot exists at the point of death, from April 2027, that pot is also going to come within the scope of UK inheritance tax. Now, we are not regulated pension providers in terms of Menzies LLP private clients. So we can't get into the regulation around pension and advise you on what to do with your pension, but be aware that pension pots come within the scope of UK inheritance tax, and it might be worth thinking about what to do with that pension pot. Historically, perhaps we've advised people to use that pension pot first in terms, use that pension pot last in terms of spending in the UK. That advice is maybe going to shift. If that pension pot goes to your spouse on death, then the pension pot is exempt from tax, because as long as the spouse exemption applies. Okay. Over to you. Martin.
Thank you very much, Helen and Anisha. I hope everyone found that useful. Again, it's a high level commentary here to give you an indication of the areas that may impact you personally. I think to get into the level of detail for yourselves, then please feel free to reach out, because it's likely that every individual specific circumstances may slightly differ from one another. Anyway, we had some good questions raised during the presentation as well as before the presentation. And I'm just going to read some of them out for Helen and Anisha to answer, and hopefully they'll find useful to most of the attendees. The first question here is from Jeff, who asked, should I say, what is tax effective after the first 4 years of being on the FIG regime?
Do you want to take that one, Anisha?
Yeah, so effectively you will be taxable on your worldwide income and gains after the 4-year regime, but you will get the availability of foreign tax credit. So if you've paid tax in Australia and they have, then you can claim the credit, or should be able to claim the credit in the UK. Not sure, Helen, if you've got anything else to add in terms of.
No, I think that the key thing to remember, and there are many questions on rental, which becomes quite relevant there. But when you're at the position where you're putting your worldwide income, so your Australian income, on your UK tax return, what you need to think about is making sure that that is for the right period of time, because unfortunately we do not have coterminous taxes. So it needs to be for the right period, and it needs to be based on the UK tax principles. So particularly for rental, it needs to that rental income needs to be based on the way that we calculate rental income. So there can be some slight, I guess, idiosyncrasies in the way that it appears on a UK tax return for what period it is and what the Australian tax credit is. But I think it sounds to a certain extent more alarming than it actually is because of the presence of foreign tax credits. Thanks, Martin.
Thank you very much. Emma's asked a question: can you be resident of both the UK and Australia? You mentioned this earlier, Anisha. Typically, historically, you're typically one or the other, but as you highlighted, there is a possibility of being dual resident. And if you can just touch on that again for us, please.
Yeah, so if you're tax resident in both the UK and Australia under the respective domestic laws of each country, then, as I said before, you will need to look at the treaty and see under which of those tiebreaker tests you would be considered treaty resident. So going back to permanent home, centre of vital interest, your habitual abode, and potentially nationality. Once it's determined under the treaty, so for example, if you were considered treaty resident in Australia, you would then look, and generally Australia would have primary taxing rights on those incomes, so you would exempt it from UK tax under your tax return in general cases.
How common is it? I mean, if you got someone living permanently in the UK, are they definitely going to be UK tax resident, or can they have a dual residency? Is it more related to the people who are travelling back and forth, or can you be full-time resident in the UK but still have joint residency?
So
I think, yeah, go on. Sorry, Anisha.
No, that's okay. Yeah, so you can, it probably will apply to those who are travelling more between the both, because, well, under the UK, I think obviously you've got the 183-day test, and I believe the same applies with Australia. But obviously with the UK, there are more kind of, if you've got a permanent home in the UK or your only home is in the UK, that can make you tax resident. So Helen, so what were you going to?
Yeah, so I was just going to say that I think when we have clients moving in and out of, let's say, Europe, so much closer, it is much more common to have good periods of time where there's a dual residency position that carries on throughout. With many clients that I've seen from countries such as Australia, it is more likely to see dual residency at the beginning and start of their period of time in the UK. So it's almost like a period of change. And maybe the middle years are slightly more likely to be just tax resident in one jurisdiction or the other. Yeah, and then they move back out of it the other way round as they leave.
Yeah, that makes sense. That's what I thought. We've got another question here from Margaret. It's a good question. For a long-term resident over 25 years who leaves the UK to return to Australia, does the full 40% IHT apply for the 10-year period, or is there a scaled percentage over the 10 years? Good question.
Yeah, so I'm afraid there is no scale percentage. So it is flat rate 40 while you're within that UK IHT tail.
Thank you very much. So it seems pretty.
It's a bit damning,
harsh,
isn't it?
Isn't it?
Yeah.
Yeah, sadly. We've got a question asked before the webinar from Laura, who says, what are the tax issues when relocating assets and yourself from the UK to Australia?
Let's
So-
think. Yeah, go on, Anisha.
I was going to say, well, if you're relocating yourself, then obviously consider your position both in the UK under the SRT and what makes you tax resident in Australia. If you're relocating assets, maybe Helen you can touch on that one.
Yeah, so let's take something relatively simple to start with, such as a bank account. So I talked about whether an asset is UK situs or not in light touch earlier, which basically means, is it a UK bank account, then it's a UK asset and it's chargeable to IHT. Is it an Australian bank account, then it depends if you're long-term resident, whether it's caught to UK IHT. But the movement of those funds, you close a UK bank account and you pop it into an Australian bank account, then that changes the nature of that asset. So it might be quite simple, such as moving cash balances overseas. You'd need to have advice, but it is possible to transport a pension fund. But you'd need advice from an IFA who can deal with multi-jurisdictional issues when it comes to pensions. Moving other assets, you can't physically move real estate, obviously, but you might think about selling down your UK real estate at the point that you're thinking of leaving or have just left, and reinvesting that money overseas. So each of those elements brings with it a tax consideration. So if you sell a UK property, is the UK capital gains tax to pay? Is there Australian tax to pay? And how does that need to be reported?
Thank you very much, Helen. Eliza's asked a good question. I'm sure many of us living in the UK have elderly parents in Australia. What should we be doing to prepare for the inheritance tax implications if they pass away while we are in the UK?
Okay, so there was a very similar question, I think, before the webinar as well. But yeah, I think the key thing to remember with UK inheritance tax is it's a tax on the donor. So this is not a tax when you receive inheritance from somebody overseas. What you do need to be aware of is that once you have received those assets now legally yours, that they are now potentially within the UK tax net, depending on what you do with them next. So those assets that you inherit might yield income. That income needs reporting and needs taxing, depending upon your tax status and your residence status. If you sell them, there will be capital gains tax based on the difference between the value when you inherited them and the value at sale. And finally, they will now fall within your estate for UK inheritance tax, and they might be situated in Australia, but if you're long-term resident or you've left and you've got a tail, then they're within UK inheritance tax scope. So again, insurance might be worth considering to manage the risk while you're still here in the UK.
Very comprehensive, Helen. Thank you very much. We've got a good question here from Sandra. If you have rental income from investment properties in Australia, which are negatively geared, and hence you pay no Australian tax, how would this be taxed in the UK after the first 4 years? Are any expenses deductible?
Yeah, okay. So what I can't comment on is exactly how that is taxed in Australia, but take that aside. In terms of how we tax that rental income in the UK, we have to do it on UK principles. So I touched on this earlier with dates and period and various things. One of the key things to note is that we don't take a deduction for depreciation or amortization of the asset, but we take a deduction for the normal rental costs that you'd expect, like repairs, insurance, etc. But the key thing to note is finance. So you're saying that these properties are geared. So the mortgage interest on those properties for UK purposes, that is restricted. And that restriction needs working through. So there is not generally as much relief in the UK for mortgage interest as there might be in another jurisdiction.
Yeah, we do taper mortgage interest quite significantly now, don't we, Sadly?
Yeah, we do. So it needs looking on a bespoke case-by-case basis.
Yeah, sounds good. Margaret's come back to us and asks, does IHT apply to assets left to charity?
So there is a charity exemption where assets are left to a specific charity generally, and that might be generally in a will. So it might say this is going to, I don't know, the Red Cross, the British Heart Foundation. And there's a charity exemption for that, just like you were passing assets to a spouse. And also, if there's a significant part of the estate that's left to a charity, it can also reduce the 40% rate down by 10% to 36%. So bespoke advice and some help with will drafting to see how that works.
Thank you very much. We've got a couple more. We've got David who asked before the webinar, any changes foreseen in the application of the Australian-UK double tax treaty?
No foreseen changes, but as we highlighted before, it'll probably become more prevalent. So it's definitely important to keep the treaty under review when you're reviewing your overall residence position between both the UK and Australia. Yeah, it's going to become really important, Martin, with looking at who has primary tax and right, who has a secondary tax and right. So it's not, the double tax treaty is not just there to look after the situation where you're dual resident. It goes through source by source, different types of income gain to decide how it's going to be taxed and where it's going to be taxed. Both one place, however.
Fantastic. We've got a question from Miranda. Can I keep my stocks and shares ISA if I move back to Australia? And what happens if I liquidate while I live in Australia? We might not be able to answer that from an Australian perspective, but...
No, so I can answer it from a UK perspective. So I believe that your UK ISA can stay intact if you become non-resident, but you can't add to it anymore.
Yes, that makes sense. Thank you. Oh, we've got a question here from Stephen. If you're living and working for a salary in the UK, circa 10 years, and only have minor income from an Australian rental property, former home, when your UK bank account asks the following, I should have screened this question, update your tax identification number. Our records show that your tax resident in Australia is correct. In this case, that you are a UK and Australian tax resident. In this case, are you an Australian UK tax resident? Well, I'm not sure you would be, but if you're living in the UK, any comments on that?
Yeah, I mean, your tax residency position will be determined where you physically are. If it is a case of spending time in both those properties, which it doesn't sound as if you are because the Aussie one is rented out, then it doesn't feel like we'd fall into the double tax treaty for being dual resident because you're spending time in two permanent homes. So we fall back to that position of your UK taxable with your Australian property rental needing to be reported in the UK.
Thank you
that answers the question.
Thank you very much. We just had one last one come in. I think I can bring in. Nathan has just asked, there has been some discussion on bringing in an exit tax if you leave UK domicile. Do you have a view on these discussions as of yet?
I think it's likely. I think they're all a bit busy at the moment, so let's hope it's not going to be yet. But I think there is many jurisdictions have an exit tax. In terms of timing, I don't know, but it's probably going to sit top of my list of things that could happen.
Okie dokie. We've got a question here from Belinda. For a rental property in Australia, will Australia be considered the primary taxing place? My understanding is I will pay the tax there first and pay any additional tax owing to the UK once this has been credited. Is that right? Is this the best strategy to manage cash flow if the majority of my income is earned in Australia?
So we look at the treaty to determine where the jurisdictional right to tax sits. Martin, did you say rental there? Did you say property?
Yes, it's a rental property in Australia, yeah.
Because that's Australian real estate, I'd have to absolutely double check the treaty for every eventuality, but my gut instinct is it will be a primary taxing right in Australia. So Australia will effectively tax it first, and then we'll take credit in the UK.
Makes sense. A question from Miranda, which we probably can't answer, which is how much is the exit tax likely to be?
Absolutely no idea, I'm afraid.
Yeah. What is it in other similar jurisdictions? I don't think other similar jurisdictions really matter in that instance, because we get to decide it ourselves. But yeah, I think it's just murmurings at the moment, which may likely come in further down the line. But as Helen said, the governments have got other things on their mind at the moment, so hopefully that distraction's for a little bit longer before anything comes in on that side. So I think at 9:58. Those are all the questions that have come in live. We covered some of the ones that were asked before the webinar. As I say, you've seen our email addresses. Hopefully we'll pop them up again now. They will go on in the email shot that comes out to you as well. And if we get permission for the people that ask questions beforehand, we can email you directly in response to them as well. So again, thank you all for coming. I'm just going to hand back to Richard now. And any further questions, those are our contact details. Please feel free to reach out and we can help you, as many as you as we can. Thank you. And thank you, Helen and Nisha. A great presentation. And back to you, Richard.
Yeah, thanks, Martin. And thanks to the Menzies team. I wish I could say this area is simple. It's not. There were two words that Anisha used in her presentation, which I'm going to repeat: advanced planning. I can only just reinforce those two words to everyone. Get advice on this whole area. It is not simple, and there's a lot of money to be saved, I dare say, or not shelled out if you can get some great advice. So I just need to sort of provide those. That advice from my side. Advanced planning, it's absolutely key. Can I just make a couple of other comments before we wrap up, and well and truly on time? We've got a couple of other sessions coming up, which I think might be of interest to the people on this call. We have firstly a webinar coming up at on May 27th, which relates to visas and the various pathways and the changes that are happening with regard to visas. And that relates to both individuals and employers. So again, worth tuning into that webinar to understand how your visa status may have changed or may be changing, or for employers, what it may mean for sponsors. And just as another something we do every year, which is called Going Home, which delves into some tax advice on movement of assets and portfolios and pensions back into Australia. And again, that's a very popular webinar and works very, very well and complementary to the Menzies advice. So on that note, and on 10 o'clock, thank you. This has been recorded. It will be posted on our website, and we will send all people that registered a thank you email with a link to the webinar and also contact details for the team at Menzies. On that note, hopefully no exit tax in the short term, and let's watch what's happening in UK politics over the course of the next week or two. It should be proved very interesting. Thanks everyone, and have a good morning.
Thanks everyone. Appreciate it.
Thank you.